Right, welcome to today's webinar. I'm Jasper Lawler, covering this webinar on behalf of London Capital Group, LCG. So I'm assuming you've all had a chance to read the risk warning on the screen at this point. Let's switch gears to the webinar today, which is about trading breakouts. Now, I should say that at any point, if you have questions, please feel free to slot them through to the question box right there on the webinar panel, and I'll answer them straight away if I can, or perhaps we'll just leave it towards the end. We'll have a little dedicated Q&A session. This webinar will be available on YouTube and social media to watch afterwards as well. So what I'll be covering today is just the basics to start with. So what in fact is a breakout? Why would you want to trade breakouts in the first place? One of the most common pitfalls and thus questions about breaks is false breaks. So I want to discuss a little bit about how you want to try and avoid false breakouts. Entry techniques when it comes to breakout. How do you actually take advantage of that potential breakout? Where to set stop losses is obviously always an important consideration when you're trying to minimize the risk, and maybe a little Q&A at the end if we have time. So what is a breakout? Quite simply, breakouts are when a price moves out of a period of consolidation. And so the idea is that when you enter a trade on a breakout, the price is moving from a phase of consolidation to a trend. So the price will begin to trend in the direction of the break. So you're getting in right as this trend really gets going. So in an uptrend, a breakout would typically be above a significant high. In a downtrend, the breakout would be below the significant low. And you can see that on these very simplistic diagrams I've drawn here. You know, here the market starts to move higher, pulls back, and the idea of the breakout is that you don't know at this point in time, you know, after the pullback, whether in fact the market's going to completely roll over and top out. But once you see the breakout happening and a new high being formed, well, then you have a lot more confidence that the uptrend is continuing. Obviously, part of the definition of an uptrend is higher lows and higher highs. So you've seen this higher low to start with, and then you get the confirmation with the higher high at the breakout. And then again, you know, the idea is that as the trend maintains, you get another little consolidation, and then the breakout again. That's the logic. Same exact thing with the downtrend. Obviously, with the downtrend, the definition is lower highs and lower lows. So you get the lower high to start with. That's your first idea that maybe this down leg is going to continue. You know, we don't come up here and make a new high up here somewhere. We make a lower high, and then we make a lower low at the breakout point, and continue lower, make a fresh low, rebound, consolidate, break lower again. All fairly straightforward so far. So why trade breakouts? There are both pros and cons to trading breakouts. Right up there is that you're trading with the trend. You know, the probability is always significantly placed in your favor if you are in fact trading with the momentum that's already there in the market. This is very much a trading related concept. We're obviously not talking about investment here where you're like trying to buy at low valuations to ride out for a long-term shift in market sentiment. We're talking about trading and where the movement is currently shifted, you want to go with that movement. It's good for catching quick price moves, as I kind of alluded to. During that consolidation or during that pullback, prices are chugging along a bit slowly. You don't quite know when or if the trend is resuming. The idea of the breakout is that's when things really kick into gear, and the price can move very quickly after a breakout. It's easy to see when you're wrong because it's all about that previous high if you're trading a breaker higher, that previous low if you're trading a break lower. If the price then moves back past that breakout level, then pretty much you're within a margin of error. You know, the breakout idea is wrong. and so then you can cut your losses with minimal loss ideally. But if in fact the breakout does work out and there is a strong price move, then the risk to rewards can be very favorable with breakouts. Another good thing, and we'll talk about more about this in another webinar I'm doing on trading pullbacks, but one of the issues with trading pullbacks is you can often misjudge where the pullback will finish, and it can mean missing opportunities. With trading breakouts, you're always kind of trading almost as the trend has already started, so you're not waiting on some specific price level being hit. You're trading right into the trend, if you know what I mean. This will become a bit more clear when we actually look at the chart. But you tend not to miss opportunities with breakouts. Actually, it's almost the opposite when it comes to trading breakouts, is that you have false breakouts. So you're almost trading, you end up trading more often than there are real opportunities. So you won't miss any. In fact, you'll take a few that you didn't really want to take. The other major con with it is that obviously you're buying right at the high. Generally, the old theory is that you buy low, sell high. Obviously, with a breakout, you're in fact buying high, and if you're trading a lower breakout, you're selling low. So that can be sort of psychologically difficult, because you feel like maybe the move has already happened and you're selling at the bottom, buying at the top, and it can often prove that that is in fact the case. The market's already dropped and you're selling just as it's finished dropping, or likewise the market's already moved significantly higher and you're buying just as it's starting to roll over. So they are risks and considerations, but we'll try and consider some ways to mitigate them in just a minute. So that first thing, how to avoid false breakouts. Well, as you may have guessed, you can't completely avoid trading false breakouts. That basically is one of the costs of doing business when it comes to trading, is that there are always going to be losses. The idea obviously is that the amount you win adds up to more than you lose, but you will always lose some. You can't avoid breakouts, but you can minimize them. So, another way of putting this is, oh, I've got a question in there about pullback, apologies for that. How can we minimize them is the question. So, number one, and we've already half alluded to this, look for a trend to be in place and trade with it. If the market is very much a range bound, as you can kind of see in this example, yes, there's a break above an old high there. Yes, there's a break above an old low there, but there isn't really any established trend in place. And so you're going to be a lot more liable to false breakouts if there isn't momentum building into a new trend. We're just stuck in a range. Now, this will become a bit more clearer when we open up the trading platform in a minute, but what you ideally want to see is some sort of consolidation before the breakout. Now, this goes back to this idea of buying high and selling low when you're doing breakouts. If the market has already dropped substantially and it's been falling for a long period of time and then just falls straight through the level that you consider the breakout level, you are a lot more liable to this false break, where the market needs to, it can't go down forever, it has to snap back at some point. And if it's just been falling like a knife straight through the level, oftentimes once it's through that level is when it begins the consolidation phase, and oftentimes that can mean a pushback through the breakout level. Again, a bit clearer when we have a look at the chart. The other thing is that these levels are always they're not precise. They're more like zones of interest for people who already have a position in the market. No one, there's obviously millions of traders out there, billions of trades being placed, so they're all not taking place at the exact same price level. It's kind of zone of interest when you're talking about support and resistance and previous highs and lows. So with that in mind, giving in mind that, you know, we're not dealing with a precise world here, what's often a good thing to do is wait for a close of the particular time period that you're trading to confirm that the breakout is real, or B, just set a certain number of points or a percentage of the price beyond the breakout to, again, add a bit more confirmation that it's real. If it just moves 1 point above the previous high or 1 point below the previous low, you know, certainly that could work out, but is less chance than if, for example, it had moved 5 points, or if it had moved, you know, 1% of the price beyond the breakout level. The specific numbers involved depend really on the market you're trading, and it really just requires a bit of back testing, of going back through the charts, and a bit of forward testing to see what works in terms of specific percentages and points. And obviously, to a certain extent, all of them work, but just certain opportunities will work for certain numbers, certain opportunities will miss for the, in my opinion, probably all to some extent within a reasonable level, it all kind of balances out. So let's just have a quick look at the trader platform here, LCD trader platform, just to kind of visualize some of these concepts. Let me full screen this if I can. So we've got just the current price chart for cable for the British pound against the dollar. You know, I'm looking at Forex right now, but you know, these concepts, they work for stocks, they work for options, they work for bonds, commodities, indices. Pretty universal stuff, but just so happens I'm you know, putting up a cable chart at the moment. So if we start with the opportunities here within, as I've kind of highlighted them here. So the prior move that we've had coming into this this period here is down, right? So we're in a, you can largely agree that this was a downtrending move. And so if we are in fact wishing to trade in the direction of that trend, we're really looking for down breaks. So perhaps unsurprisingly that once we put in this low here, and worth noting that obviously it's so important to always just consider generally where we are. 135, a big round number. Price tried to break through 135 after a big drop and spiked right higher. And so 135 ultimately is the big round number that the large institutions were focusing on, and why this took a period of consolidation for it to eventually break. So 135 initially held, and so you start to think, well, okay, the market's already dropped a fair bit. You know, it did drop a lot more than that, in fact. It's come from a lot higher price. No need to particularly look at that for now. So obviously there's a temptation to think, well, maybe there's a bottom in place. You know, one low, double bottom, break to the top side. But really, because the downtrend is so established, this breakout that you could have taken here was going against the trend, and thus it was very likely to be a false breakout. And the same thing here. Again, false breakout. You know, if you didn't learn your lesson, you can go for it again. Still, there's still that inherent weakness in the market, and it's going to take a bit more than just this little consolidation for the market to bottom out. So I've added those points we mentioned there and just some text on the chart. So we covered look at a trend and trade with it. Obviously, this particular opportunity is not really doing that. Arguably, within this particular scenario, there's a certain degree of, well, sometimes you get false breaks and it's completely unavoidable. A couple of things that would have avoided this situation. One is there wasn't too much in the way of a kind of shorter term consolidation before this break. So the market got as high as up here, and then in the space of 2 days, it's in the space of 8 hours rather, just completely tanked about 150 points. So quite a big price move in a short period of time, and it got exhausted And again, there wasn't quite the confidence to break 135, and we had that false break. The other thing being that if you had waited for a close of the market below this level, a close of the 4-hour time frame we're currently looking at, perhaps you would have looked at a 1-hour time frame close. Quite likely there perhaps was one of those in there if we have a look. But the point being, on the time frame that we're looking at, the 4-hour, there wasn't a close of the candle below there. So had you waited for that, you obviously wouldn't have even taken this position. There was a fair decent move below the price level, and so in terms of margin of error of entry, well, I think you probably would have been covered there. It did move a decent amount through the level, but it's, you know, still a false break. I think a good example of where that margin of error comes into play is, for example, again, you're looking counter trend, which is not ideal, but then you look at this little tiny candle here. And again, even this next candle, not a particularly big price move through the level. And again, it kind of didn't work out. So then eventually the weakness starts showing up in the price. So here we've been, you know, testing upper and lower bounds of this range. Eventually we only really get as far as the middle of the range. To say again, if we've got kind of specific highs and lows here, but really what is it we're dealing with? It's you know, it's 136 to 135, right, is basically the round numbers involved. And you can see here that at this point the market only reaches the middle of this price range at 135.50 and then again rolls over to test the bottom of the range. So the weakness is starting to show itself here. We come down for another retest of the range, and what's nice is that we do get a little rebound off the range here. We've already had one rebound off the low, come back, another little rebound. So the market hasn't been tanking all the way down. It had that little rebound, that little period of consolidation, and then eventually we did get the break lower. Now, this is almost an example of, well, you know, the break did work, but it wasn't too sustainable. By the time we did get down to this level, it had been quite a fair big drop, and we ended up rallying back up to that initial lower from over here as resistance. So it may well have been that you took this particular break, but actually, you know, you probably had to re-enter the market again on this break, and you can see that actually the market moved nicely lower beyond that. Now, this is an example where if you had waited for the close, you would not have got as such a nice entry as if you'd just entered on the raw market action. So that's something I'm going to discuss again in a second. Moving on to the next example, you can see that here another example where the market just tanked straight into it, false break, and we did move back through the level. Here there had been more of a consolidation phase, and then when we finally took out this level after the consolidation, you know, as I said, wait for this consolidation before the breakout. We had some sideways movement here where basically the buyers weren't really able to push the market higher, but there were people buying, but the sellers were kind of absorbing all the buying, and then eventually the sellers won out, took out the level, and another nice move down. But worth noting, of course, that again we came down to 132, almost exactly on the nose, just missed it, I think, and the market rebounded off the round number. So always worth bearing in mind the round numbers in terms of possible rebound levels, and it may have just been a short rebound before we took it out, but in this case actually it did put in an interim bottom at 132. Now another instance of well, the market's hit 132, come up, it's looking quite strong, maybe it's about to take out this high, but no, in fact it's a little false break, probably not enough margin of error for the entry, and going against counter trend. This was not a particularly good opportunity, but again the market doesn't come down and take a new low, it pushes out to the top side this time, again going counter trend, dips a little bit through the level but actually does push higher. And then another example here where, well, you are still kind of going against all this momentum. Sellers came back into the market at, again, you'll be unsurprised to see a round number or just ahead of it, 134. The sellers came in and sold the market right down again. So this particular break to the top side, not so valuable, but you notice how the market is trending higher, making higher lows. So actually, on this particular low, there was no false break. If you've been looking to break out, looking for a break through that level, well, it didn't happen because it's hitting higher lows. So all the while, if you're looking for the market to roll over again, you're not getting any trading opportunities as the market consolidates higher, but you're also not losing trades. You're waiting for that longer term trend to resume with a break of a low, but none of the lows are being broken for right now. So it's nice when these breaks of the highs are a bit choppy because you're against the higher trend, difficult to deal with. If you're just going with the trend, you're not taking trades, you're just waiting for the good opportunity back in line with the major trend. So it's keeping you out of these opportunities which could have been profitable but were a little bit difficult to handle. So if I just jump back to the old presentation here, now I want to cover about how to enter on the breakout. Now I've already started to allude to this a little bit, but basically there's two main options. Enter straight away. So as soon as the price moves through the level you've got in mind to denote the breakout, jump in and place a market order there, or you already have a stop order pre-planned above the high or below the low, for example. The second option is you wait for a retest. So a retest meaning that after the price has already moved away from the breakout level, the breakout's happened, but then it gets a little bit exhausted in the short term. After the breakouts happen, the price edges lower into what is basically a pullback and comes back and tests that breakout level. So you've seen that the breakout has happened, but you're waiting for a slightly better price level, and if in fact the level holds for a second time, then it's a bit of extra confirmation that the breakout's more valid. So that's kind of the two ways of doing things. Each have advantages and disadvantages. If I do jump back to the trading platform now, again, I kind of mentioned earlier that if you'd waited for a pullback in some of these chances, for example, this one, the break was lower. Depending on where you put your stop loss, if you'd in fact not traded that initial but waited for a pullback to that level with maybe some margin of error above that significant level, or maybe above 135 in terms of a stop loss, then you could have potentially entered on a much better level up here. Similar thing down here where we had the nice break, but actually the market bounced right back up to the round number, up to 134, which correlated quite well with that old low where 34 had been support, came down. So it wasn't the old lows necessarily, it was more like the closes. Again, that's why I'm talking about zones. You can't just have a stop loss of 5 points and expect these breakouts to work. But you have the breakout, come back, and then enter on the pullback. That's quite a large example of a big move. It's almost like a pullback trade, that one, rather than a breakout. But you can get other examples where, in fact, like more this most recent price action where you've seen a move above the price level. It's already moved up for a few hours in a row, so you get a little consolidation, the little retest to the level here, the small candlestick. It's a bit hard to see if I zoom in a bit. You can see this was the level, false break initially, then the confirmed break, then the pause back at the level, the pullback, and then the move higher again. So that's an example of waiting for that retest working out. Obviously, if you traded this initial level, depending on where you put your stop loss, you'd probably still be okay. Your entries around here somewhere. Depending on where your stop loss is, again, you'd still be in the trade. You just have to kind of weather this period of consolidation. Then you'd be all right. This one waits for that pullback, and then you move on again. You can also avoid oh, this is actually quite a nice example here actually, where you get the break of the low here, pull back to the level precisely, little pop above it, but then right back down to the closing levels. The only problem being that we've got that big round number down there. We don't quite get back down to those lows. So again, the way you protect your profits will probably impact how much you can take out of this particular retest trade. So as you can see, the general theme here is there's lots of options, lots of ways of doing that, and you can see the way these levels are being respected, pulled back to, broken, sometimes with a retest, sometimes with not. All of these different variants on breakout trading work, but you just have to understand the pitfalls of your particular chosen strategy and just be consistent with applying it, and know that, again, you can't minimize, you can't completely reduce the false breaks, you can't completely remove all losses, but you have a consistent approach, and well, if I do trade right on the initial price move, like if I zoom out again, we're kind of simply listed, if I trade on the straight away option, probably I'm going to suffer from more false breaks, but I won't miss any opportunities. If I wait for those retests, maybe the market never retests the level and just keeps plummeting or keeps rallying, and so you miss the opportunity. That's the risk of the retest approach. So you can see, again, both work, but there's different pros and cons of each. So lastly, just a quick consideration about stop losses. I've put kind of 3 options here, but ultimately one of the nice things about trading breakouts is that the stop loss placement is fairly straightforward, because the idea is that it's broken through this level, that's significant, and it's going to hold above that level in terms of an up breakout, and it's going to hold below it in terms of a lower breakout. So the whole premise of your trade is based on the idea that that level has broken and it's going to hold. So you want to put your stop loss somewhere below an upwards break, above a downwards break. Obviously, what you can do is you can set it a certain distance before the breakout level. So a certain number of points, a certain percentage, or in fact, you could use a previous level of support and resistance, which tend to be a little bit further away, but maybe add a bit more security in those instances where the price does push a little bit through the level, like the example where we were looking at, where it wasn't quite the low that worked. For example, it was more like it wasn't the low, but it was more like the close, where you add a bit of a margin for error by putting that slightly wider stop based on some other important price level, like a support and resistance or a round number, for example. But ultimately, the idea being that when you do get this kind of break, your stop needs, the idea is that, when it does work, that, let's go look at a historical example. Say we're trading this particular breakout level here, which is probably one of the better ones in this market environment. Market tanks through, you have your stop somewhere maybe above this little consolidation phase. So the level is pretty much 133.91. Say maybe your entry, it would be more like give it a few pips in this case, because it's the forex market. You'd say 133.87, maybe it's 5 pips below, and then you would say maybe 10 or so pips above. So you're looking at something like a 15 pip plus spread stop loss. But the nice thing is that even if you get a bunch of false breaks, the potential reward on this trade is down here at 133. Obviously, you've been targeting the round number, kind of. You never want to put your take profit right at the round number. If it's 133, you probably want to put your take profit at 133.10, perhaps. And in that case, you would have called the bottom perfectly. There are other ways to take profits on trades which are pretty universal, and it's a universal across whatever strategy you're using, particularly in trend following. For example, using a close above a previous candle. So in this case, the market rebounded, you'd still be in the trade, here, and then eventually you'd get out of the trade there. So even there, 133.57 from 133.87, I think we said. You're looking at 30 points. Even that fairly conservative approach, which means that quite a lot of a rebound off the low, you're still looking at a 2-to-1 ratio. So whether you're using profit targets or whether you're using a kind of trailing stop approach, typically if these breaks do work, the profits you can earn will be a lot more than the kind of small risk that you've taken with having an entry somewhere below the break lower and a stop loss somewhere not too far, but with a reasonable degree of comfort above that level that you consider important. Now this is a 4-hour chart, so I kind of reference the number of pips appropriate to a 4-hour chart. Obviously bear in mind, if it's a daily chart, you probably want to add a few more pips on top of this. If it's a 5-minute chart, a few less. It's obviously all proportional. The kind of stop that you have in place wants to be proportional to the intended profit target. So how do you really get started with this? Well, this is a pretty common slide that I include most of these webinars. Is you really have to, don't take my word for it, go back through the price charts, look for examples, construct a plan to use it, and then start using it, forward testing, place trades in your demo or your live account, and obviously readjust from there the small nuances like the number of pips you need to see before the break is valid, etc. Whether you use the close on the breakout or whether you use the raw breakout itself, whether you use a retest or whether you just trade straight on the breakout, all those sorts of variants you just need to come across through yourself. Be aware of the options and try different things and see what works for you. Thank you very much for attending. I'm going to call it a day there. Really appreciate you attending, and again, if you want to rewatch, it's going to be on YouTube. And if you want to kind of follow some of the ways I'm tracking the market, please have a look on Twitter and TradingView and some of the social channels and on our other videos on YouTube. Thank you, everyone. It's Jasper signing out.